Hi everyone, Maria Tyler here. In this video we're going to go through capital budgeting and look at some techniques which we can use to appraise whether an investment is likely to create its value or not. So what is it? It's essentially analysis of potential capital projects for long-term strategic decisions. It usually involves very large amounts of money, so large expenditures, and usually once you've committed you can't easily uncommit or reverse those decisions. We're talking about a firm's strategic or long-term. So make sure that every investment, firstly, before we even apply any of our capital budgeting techniques, should firstly be appraised in relation to our long-term or strategic vision. For example, if you're personally looking at buying a car, if you know that you're going to need a family car in a year, there's no point even looking at sports cars as a potential investment. So look at your long-term or strategic vision and then see whether this investment fits in with the strategic vision. If it does, then we can apply some of our techniques which we go through today. So this is very important. Firstly, all investments should be firstly appraised in terms of the overall strategic direction of the company. Okay, once we establish that it is within our strategic vision, then we have a look at some decision criteria, and usually all of the capital budgeting methods will address one or more of these. So do we consider all of the cash flows? So not all of the techniques consider all of the cash flows. For example, payback period doesn't. Is it risk adjusted? Is there an ability to rank projects based on our different tools that we're using? And will it indicate the value that it adds to our organisation? They're considered the good decision criteria. We have what we call independent or mutually exclusive projects. So if projects are independent, that means we can basically choose all of them, whichever ones we want. Each independent project we could choose, as long as it's going to be a good investment, we could accept it. Mutually exclusive projects is not the case, it's the opposite. It means if we accept this project, then we can't accept the other. They're mutually exclusive. So the acceptance of one project precludes accepting the other. For our unit, we're just going to focus on 3 capital investment appraisal methods. So payback period, net present value, and internal rate of return. And they're the more commonly used appraisal methods in practice. The one that I most commonly use with my clients is net present value, and in conjunction with net present value, internal rate of return. Another one that is fairly commonly used is the accounting rate of return. So if you are interested in that, you can Google about it. But for this purposes of our unit, we're just going to focus on these 3 listed on the slide here. Okay, so with the first one, the payback period is probably the easiest to understand. It's how long is it going to take me to be paid back for the initial investment that I've made into this project. So we have to estimate cash flows for each period, and then basically so we have an initial investment amount and then take off all of those cash flows until the initial cost is recovered. So we're taking off every year the incremental cash flows that we get until finally we've been paid back for our initial investment. And so it's essentially a break-even type of measure. The decision rule is accept the project if the payback period is less than your preset or acceptable limit. So if we calculate a payback period of 2.5 years and our acceptable payback period is 3 years, then we would accept that project. If our acceptable payback period was only 2 years, then we wouldn't, because it's 2.5, which is longer than the acceptable payback or preset limit. So as an example, if you have nice even cash flows, you can simply put it into a nice mathematical equation, investment amount divided by the investment return. So how long until I get paid back for our investment of $5,000 if it returns a nice cash flow of $200 per year? 5,000 divided by 200 is 25 years. If that same $5,000 returned me $2,000 per year, it would only take me 2.5 years to be paid back. But in real life, you don't normally get a nice even cash flow amount like this. You normally get a different cash flow paid back every year. Well, capital projects for companies usually return a different cash flow every year. So we have to bring in cumulative cash flow. So here's another example, just calculated out with non-even cash flow. So we're assuming that our investment cost us $100,000 and we've got estimated cash flows over the next few years of of 15,000 for the next 3 years, so 15, 15 and 15, and then 30,000 a year for the last 2 years. What's our payback period? So this is our logic. Year 0, which is right now, times 0, our cash flow is negative 100,000. We're paying that. At the end of year 1, it's the negative 100 plus the 15,000 that we got back for year 1. So we're at negative 85. In year 2, we start with the negative 85 and we add the 15 that we get for year 2. So we're at negative 70. For year 3, we start with a negative 70. We add the 15 that we get in year 3. So we're at negative 55. In year 4, we start with a negative 55. We get 30,000 in the last 2 years. So 30,000, we're at negative 25. And in year 5, we start with a negative 25. We get 30,000. So we're actually at a positive 5,000. So we get paid back somewhere in year 5. So year 4 plus some months or days. So we get paid back somewhere in year 5. And we can actually calculate this by dividing the cash flow that we need to break even, i.e. the $25,000 that we need in order to break even, out of the total cash flow that we actually receive for that year, and then multiply it either by 365 days, 12 months, or leave it as is, as a decimal if you need it for a year. Now, a better way to calculate this would be to list out these as cumulative cash flow, and you can do this using Excel quite easily, and that's what we're going to be doing for your assessment. So you put year up the top in the first row. So year 0 is right now, and then year 1, 2, 3, 4, 5, 6. The cash flow that you receive or pay each year is then listed next as a second row. So in this case, negative 100,000. Then we get a positive 15 for the first 3 years, and we get 30,000 for the next 2, and we've tagged on 1 extra year there in my calculations just to show you the progression. Cumulative cash flow, negative 100,000. We add on the 15, so we're at negative 85. We add on the 15, we're at negative 70. We add on the 15 at negative 55. We add on the 30,000, we're at negative 25,000. And then in year 5, we add on 30,000. So we're at a positive 5,000 at the end of year 5. So somewhere between year 4 and year 5, we get paid back. Now, to calculate that somewhere, we simply take what we need, whatever cash flow we need to break even, which is our 25,000 that we need in order to recoup our initial investment. And we divide it by the total cash flow that we get for the next year. So the 25,000 divided by the 30,000. Ignore the negative sign. We're not interested in the negative. So 25,000 out of 30,000 that we need, and then times that by 365 days or 12 months, or leave it as a decimal for years. So if we times it by 365 days, we will get 304 days. So the payback period would be 4 years and 304 days. With the months, it's approximately 10 months. So payback period is 4 years and 10 months. And if we needed it to be expressed as years, then payback period would be 4.83 years. So do we accept or reject the project? It depends on what is the acceptable preset limit. So if our company decided that payback period within 5 years was acceptable, then we would accept this particular project. If our company had a accepted payback period of, say, 3 years, then in this case it wouldn't be acceptable. So we wouldn't accept this project. So advantages and disadvantages, obviously it's easy to understand. It is biased towards liquidity because it just deals with cash flow and recouping an initial investment. The disadvantages are it ignores the time value of money, i.e. $1 today is worth more than $1 tomorrow, because I can invest my $1 today and get more back with that $1 today tomorrow. So $1 today is worth more to me than it is $1 tomorrow. $1 today is also certain, $1 tomorrow is uncertain. So it ignores that time value of money. It requires some sort of cutoff point, that preset limit. So what is acceptable? It's arguable whether or not that's actually a good decision criterion. And also, this is probably the hugest one, it ignores all cash flows beyond that cutoff date. So pretty much once we get paid back, we ignore, and this is why I left this up here, we ignore the rest of the cash flows. So we might actually, so we've got cash flows in year 6, but for the purposes of calculating payback period, we just ignored it. We didn't think about it. So that's, yet it's important because not only did we get paid back, we got paid back more. So that's one of the disadvantages. So it ignores cash flows beyond that cutoff date. So that's payback period. Net present value tells us how much value is going to be created from proceeding with this investment. Now, there's two main points in net present value. There's present value and then there's net present value. And I'll go through that in the next slide. Firstly, step one is estimate all of our expected future cash flows. And in practice, that's the hardest thing to do. So in practice, actually getting or forecasting accurate cash flows over the life of the project, that is very hard to do. And when you study, you may study in business finance later on how we actually forecast those cash flows. You'll start to see some of the complexity that can be involved. In real life, I work with net present value with different businesses for different projects. And in real life, that's the hardest thing to get right, is estimating that future cash flow, because A, nobody has a crystal ball, and B, what information we do have might change depending on a number of different scenarios. So this is actually, step one, estimate the expected future cash flows. That's easy in terms of our unit. You just make them up. But in reality, be aware that's probably the most critical step. Step two, estimate the required return for projects of this risk level. This is where your weighted average cost of capital comes in. This rate of return can greatly affect your net present value. It's basically an inverse relationship. So if you have a high rate of return, it'll give you a lower net present value and vice versa. And that's, again, it's another point of manipulation of net present value in practice in the real world. So I was teaching out west at some of the mines over 5 years ago now, and when we went through net present value with their capital appraisement methods, they said in their company they used to be able to, head office would have they would invite a number of capital submissions every year, and so managers of different mines would put in for their, what capital they would like for their particular mine using net present value, so that the decision makers wanted to see net present value of each of the capital investments. And so what was happening was some managers had figured out that if they use a lower discount rate or lower required return rate, we're going to look at it in terms of discount rate or weighted average cost of capital. So if they used a lower percentage rate, their net present value was higher. So they started to manipulate their capital investments. And so decision makers, if they didn't have an understanding of this, they would look at a net present value and think, wow, this is really high, this is really good. But the reason it was high is because they were using a lower discount for the present values of the cash flow. So what the company ended up doing, once they realised that this was occurring, they realised they weren't comparing all apples with apples, all the investments at different discount rates or different required return rates. And so they ended up specifying everybody had to use 7%, I think it was at the time. So they all had to use the discount rate of 7%, which was the company's considered weighted average cost of capital. So anyway, so that's an interesting story. So this is another area of manipulation, the actual discount rate or required rate of return. And this is the rate that we discount those future cash flows that we've predicted in step one. This is the step where we discount each of those back to today's dollar value. So $200 next year is not worth $200 today. It's probably only worth, depending on your discount rate, probably only worth, say, $150 today. Because we can get more. If we invested that $150, we could get the $200 at the end of the next year. So depending on your discount rate. So you can see, how do we discount it back? What interest rate do we use to bring all those future values back to a present value? This is where the present value comes in. Then step three is we find the present value of all of those cash flows. So we add them up, we get a total present value. And then to get the net present value, we subtract the initial investment amount off, and that's why it's called net present value. So just harping on that for a minute, what does the net mean in net present value? So just a very, very simple example I just quickly whacked up. Initial investment, say $5,000, returning us $200 per year for 5 years, using a discount rate of 7%. So $200 in 1 year at 7% discounted back to present value, to today's terms, is only $187. $200 received in 2 years is worth the equivalent of $175 in today's dollars. $200 in 3 years is worth $163 in today's value, discounted at 7%. $200 in 4 years' time, discounted at 7%, is $153, and so forth. Or another way of looking at this is $187 today. If you gave me $187 today and I invested that at 7%, in 1 year I would have $200. If you gave me $175 today and I invested that at 7% for 2 years, I would have $200 at the end of year 2. So this is what discounting brings back, and investing brings it forward. So discount rate is 7%. So we're just converting one figure to the other for each time period using this percentage rate. So the higher discount rate or required return rate you have, the lower your net present value will be, and the lower the discount rate, the higher your net present value will be. It has an inverse relationship. So that's discounting the cash flows. So this is our cash flows. So we forecast that we have $200 per year returning to us for 5 years. We discount all of them at 7% to a present value. Then we add up all of these individual present values to get a total present value. The difference between this total present value of those cash flows and a net present value is we take off that initial investment of $5,000. So that's what the net means. So present value is discounted future cash flows, get a total, that's the present value of all of those cash flows. Take it away from our initial investment gives us net present value. So in this case it's negative, so we wouldn't proceed with that. So just on that decision rule, if net present value is positive, you accept it. If it's negative, you reject the project. Do not proceed. If it's less, if it's not positive, it's negative, it won't add you value to the firm and it won't increase your wealth. So only accept projects if they're positive. Net present value is a direct measure of how well this project will meet the goal of increasing our organisational's wealth. So this is another example I just want to give you with discounting back and forth. So we're looking at a new project. We've estimated these cash flows for the next 3 years. Our initial investment is $165,000. Our required rate of return or our discount rate is 12%. Should we accept or reject? So in your assignment, you can easily, we're going to do it in Excel in our assignment, just to carry out this scary looking formula. But for those maths geniuses out there, I'd like to just go through this manually. It is very easy, and again, it's something you would have learnt in high school. Cast your mind back to high school if it's many years ago for you, like it is for me. So cash flow, each of the cash flows go on top, and we discount it by the number of years, T is time. Okay, so using our formula, cash flow for every year, so T is every year, R is rate, so 1 plus the rate, discounted for every year. So initially, year 0, we spent $165,000. In today's terms, it's year 0, it's right now, it's $165,000 spent, negative. At the end of year 1, we get $63,120 back. So put that into our formula. So cash flow goes on top here, divided by 1 plus the rate. So in our case, we've got the previous slide told us that our risk rate is 12%. So 1 plus the rate is 1.12 to the power of the year. So in this case, year is 1. So it's 63,120 divided by 1.12. So put that into your calculator and you will get a present value of $56,357.14. Year 2, we get a cash flow of $70,800. So again, put it into the formula, 1 plus the rate to the power, to the exponential power of 2 years, 2 for 2 years. So $70,800 is worth $56,441.33 in today's value. And at the end of year 3, we get 91,000, discount that by 3 years to that discount rate. So that is worth, in today's value, discounted at 12% to $64,828.94. So what we do to get a present value is we add the 56, the 56 and the 64, that gives us present value. Then we take it away from our 165 to get a net present value. So in this case, our net present value is positive, so $12,627.41. So we would accept this project. So that's the long way to do it. Excel does it all for you. You just put a formula in Excel and hit enter. So net present value method meets all of our decision criteria, all of our desirable criteria, considers all of the cash flows, it adjusts for risk and the time value of money. It can rank mutually exclusive projects directly related to increasing our wealth. So it's considered the main dominant method to use. So if all else fails, just use net present value. Internal rate of return, if you understand how the discount method, the discount percentage works with net present value, you'll understand internal rate of return. It's simply the rate of return when net present value is 0. It's the most important alternative to net present value in practice, and it's widely used because managers like to think in terms of rates of return. They like percentages, they can understand percentages. So actually a lot of managers prefer to use IRR, the internal rate of return, for them. So again, the higher the internal rate of return, the better the project is, and it must be above their set minimum, their preset level. Based entirely on the estimated cash flows. So it is the discount rate that makes net present value zero. The decision rule is accept the project if the internal rate of return is greater than the required rate of return. And usually that is, for the mining company we were out working with in that particular instance, it was their weighted average cost of capital. So that's 7%. So it had to be greater than that discount rate that they were using. So, so again, if it's less than that rate, then reject the project. So having a look at a quick example, we can't actually calculate it because there's no manual formula. Well, there is a manual formula. It's the net present value formula. But to manually calculate it, you have to use that formula and keep changing that discount rate to try and get net present value as close to zero as possible. So it's a trial and error method. Using the calculator, usually we'll be able to, there's a function that will say IRR. That function first and then enter your cash flows and then compute, or enter your cash flows, press the IRR button and then compute. So something similar to that. But the easiest is to use Excel, and that's what we're going to go through today for your assessments. So do we accept or reject the project? Just assume we calculated an IRR using Excel or our calculators of 16.13%. That's greater than our required rate of return. So the advantages are it's preferred. Like I said, in practice, I found a lot of managers, they like to think in terms of percentages. They can understand, a rate of return. Like if I invest my money in the bank, I'm going to get, 4% interest, 5% interest. So they can identify with percentages. So they do like it. It's quite widely used. It's intuitively appealing because people, in essence, understand what a rate of return is. And it's easy to communicate the value of a project using a percentage. It does consider all cash flows and also discounts. It includes the discount value, so it considers the time value of money. But there are a few disadvantages, and mathematically, again, for the maths geniuses, when you graph IRR, it looks like a bell curve. So it can actually produce multiple answers because the point where it hits your axes, the curve actually can hit it twice. So it can produce multiple answers, which is confusing, and it can't rank mutually exclusive projects. We'll have a look on the next slide, just have a look at some of these figures which were actually used for two projects. So the required rate of return for both projects is 10%. With project A and B, these are the cash flows, so initial investment and cash outlays for 2 years. When we've actually calculated net present value and internal rate of return, because these were mutually exclusive projects, internal rate of return gave us conflicting results to net present value. So net present value came out high for project A and the internal rate of return came out high for project B. So then you're like, well, do I listen to the internal rate of return? Do I listen to the net present value? So the answer is, of course, net present value. Net present value is the dominant method to use, and internal rate of return actually can't rank mutually exclusive projects. So just be aware of that. When there is conflict between net present value and internal rate of return, always use net present value because it directly measures the increase in value to a firm. And also, internal rate of return is unreliable with non-conventional cash flows and mutually exclusive projects, as we just saw. So just a quick summary before we go on to calculate or to show you your assessment. Payback period summary. It's the length of time until our initial investment is recouped. We accept it if it's less than our specified or preset limit, doesn't account for the time value of money, ignores all the cash flows after that payback period, and it's that arbitrary cutoff period. Net present value is the difference between our present value of our future cash flows and the initial investment. We accept it if it's positive, if net present value is positive. There's no serious flaws and it's our preferred decision criterion. Internal rate of return is the discount rate that makes net present value break even at zero. So we accept it if our internal rate of return at percentage rate is higher than our required rate of return. It's the same decision as net present value with conventional cash flows, but it's unreliable in these two instances. So just be aware of that. Don't use it if you've got those two instances. In practice, it's not just a matter of doing one criterion, although having worked with some companies in practice, that's all they do. They will just do net present value and that's it. Anyway, you shouldn't just do net present value. You should be able to do a number of these capital investment criteria. Use a number of tools that are available to you so you can actually get a broader picture of this investment. Net present value and internal rate of return are the most commonly used primary investment criteria. And like I said, I have worked with firms where they will only use net present value. Payback period is commonly used secondary investment criteria, as is the accounting rate of return. But all of the tools provide valuable information. So that's what I'm saying. If you've got tools available, you know how to use them, why not calculate all of them and just get that bigger picture view? Okay, so that's the background. So now with your assessment, you have to create a capital budgeting or capital investment scenario. So you'll have to do that in your company spreadsheet, okay? And you'll have a template on Moodle that will be from what I've created today using my example. So my example comes from my company Wesfarmers, okay? So Wesfarmers Limited is considering expansion into the small town of Claremont in central Queensland. In order to do this, they're considering two investments. So the first one is opening a new Bunnings store and the second one is opening a new Officeworks store. So currently my assumption is, well, currently they don't in reality, Claremont has neither an Officeworks nor Bunnings store. So Claremont's a little bit close to my heart because that's my hubby's hometown. So ideally, Wesfarmers would have no plans for closing these stores in the future, as it's anticipated that they would remain open for as long as they are profitable and solvent, which means they can keep operating. However, since market demand for both Bunnings and Officeworks stores in Claremont is based on Claremont's population, which in turn is highly dependent on the mining economy surrounding Claremont, it suggests that each of these projects be given a length of 10 years. And in your example, you're required to have a scenario between 5 years and 10 years in length. So make sure you stick between those parameters. The template that I've provided in my example will give you up to 10 years, so you can just knock off a few years if you decide to only use 5, 6, 7, 8 or 9 years in your example. Okay, now this is important. There would be a demolition cost for the Officeworks store at the end of the 10 years if it were to be closed down. So hint, that would be a negative residual value. However, the Bunnings warehouse could be sold to a local cattle farmer for hay storage. Okay, the cash flows generated by the Officeworks store would predominantly be comprised of consumer purchases of stationery, less operational costs such as staff wages and inventory purchases. The cash flows generated by the Bunnings store would be predominantly comprised of consumer purchases of hardware, less operational costs such as staff wages and raw materials. So this is all what I'm writing in my Word document, okay? The investment would be made on the 1st of January 2021. The estimated future cash flows are expected to be received at the end of each calendar year, so 31 December. The original cost, the estimated life, the residual value, and an estimate of future cash flows of each investment opportunity will be set out in the table below. That's on the next slide. And I've also confirmed for my marker that all amounts will be expressed in the same denomination that my company uses for their financials, which in Wesfarmers' case is Australian dollars. Now, I'm going to assume a rate of return or a discount rate or a weighted average cost of capital, the WACC, of 8%. That's just keeping in line with Martin's study guide. Okay, if you feel that you would like to use a different rate of return or discount rate, that's fine. Just write about it, justify it in your Word document. Previously to this, my examples used to use 10%. So if you feel that your company has disclosed one in one of their annual reports and you would like to use that, that's fine. By all means, use that, and you can even screenshot that page in from your company's annual reports, because your company will be making capital investment decisions. They may even tell you some of those in their annual reports. Okay, so these are the figures I will be working with in Excel, all right? So you can see I've got two columns here. I've put them into each row. So original cost, that's at times 0. Negative 77 million for Bunnings, negative 135 million for Officeworks. I've literally just made these figures up because I've never built a Bunnings or an Officeworks. So I'm just assuming these figures. An estimated useful life, my scenario is going to have 10 years. Again, yours must be between 5 to 10. I have a residual value for both of my options. In the case of Bunnings, it's a positive 2 million because remember we can sell it to the local cattle farmer for hay storage. But with the office works, we actually have to demolish it at the end. So we actually have a negative residual value in that case. So we'll have to factor that into year 10's cash flows in the Excel spreadsheet. And then I've just arbitrarily put in 10 years worth of estimated future cash flows for each option. All right. Now, here's the nitty gritty. We'll go to Excel and we'll calculate the 3 capital investment tools that you'll need. Then we'll come back to Word, to your Word document and explain it. And don't forget to do that. That's very important. You do get a few marks for that. Well, there is at least a mark allocated for that. So we'll go to Excel now. So you'll actually have this template filled in from what I do today. I'm just going to fill it in for you. So this is the example for Wesfarmers. Please don't use it. Please change it. I've put here what my figures are denominated in, which is the same as what my company's financials are denominated in. For the time period, you always put in times 0 right now because a lot of capital investments involve an initial large sum of money going out. And then 1, 2, and so forth. And usually if you highlight and just drag it across, it will automatically fill these in for you. Okay, now you can either copy and paste that or just link to the above for the time period down here as well for calculating your cash flow. Let's just highlight it and link and copy it. Let's put that in now. All right. Now the cash flow comes from your figures. So in my case, it comes from here. So I'm going to fill in for the Bunnings. I'm going to start with at times 0, my negative 77 million, and then I'm going to fill in all of these cash flows, remembering in year 10 to add in my residual value. So start cash flow is negative 77. At the end of year 1, I'm going to get in, I've still got to pay negative 4, so still cash flow going out for the Bunnings scenario. Then at 5, 15, 20, for 3 years, I've got 20 coming in. Then I have 25 for the next 2, then 10, and then 11 at the end. But remember, I've also got a residual value. I'm going to be able to sell it to the cattle farmer for hay storage for 2 million. So add the 2 in. So make sure you do factor in your residual if you do have a residual. Okay, so that's just putting in the cash flow for option 1. Now to calculate your net present value, it's very easy, but there is one little step that some students do miss. So put in equals to start your formula, MPV, open brackets. Now the rate is your weighted average cost of capital, your rate of return or your discount rate. In my case, I'm using 8%. So I'm going to put 0.08 to represent 8%. Alternatively, you can actually write it up here and you can link to that. So in future, if you change the weighted average cost of capital or change that percentage, it will automatically flow through. In this case, I'm just going to hardwire it in instead of linking it in, which probably isn't the best option. Then I'm going to highlight all of my values from year 1. This is a very important step. Okay, so highlight all of the estimated future cash flows because what we're calculating, or what Excel is calculating, close bracket, hit enter. This here is the present value of all of the future cash flows. Now, if you remember the lecture that I just presented on net present value, we have to actually take off the initial investment to get the net, the N part of net present value. So at the moment, Excel is calculating the present value of future cash flows for me, discounted according to 8%. I need to make sure that I'm taking off this 77. And because I've already entered it as a negative, I can just simply put plus. Now this will be a net present value, not just a present value. So it's positive, which is good. Internal rate of return is done similarly. So equals to start the formula, IRR, open bracket. So highlight all of your values in this case. So this is different to net present value by that first times 0 value, comma. And where it says guess, you need to put your rate of return in. So again, you could link to it if you've put it up the top. In my case, I'm hardwiring it in. So I'm going to put 8% in there and now hit enter and it will calculate your internal rate of return. Okay, so that's 2 done. That's how quick it is.
Net present value, internal rate of return calculated. My cash flow, I'm just going to copy and paste that. Nice and easy. Okay, escape to get rid of the rest. Now, so I've listed my cash flow in. This is for payback period. Now I'm going to calculate my cumulative cash flow. So at the end of year, so at the beginning of my investment, I've spent 77 million. At the end of year one, I've started with negative 77, add on negative 4, which increases the negative, to negative 81. Again, at the end of year two, I started with negative 81, then I got 5 in, and so forth down the track. Now, Excel will actually copy and paste that formula for you. Just drag it across. So you can see eventually at some point between year 6 and 7, my investment actually becomes positive. So to calculate the payback period, we go right up to the time where you see the last negative. That's the year that you get paid back. So at the end of year 6, we still haven't got paid back, somewhere between 6 and 7. So at this point, type in 6 years, okay? So scroll your eyes on the cumulative cash flow up until your last negative point, and then you can do your apportionment. So we'll do days, months, and years. Okay, so I should actually just put, you know what, I'm just going to link it in straight to that. So 6 years, no, let's leave it at 6 years because I need it to be separate to my days, months, and years. And let's do a formula. So all we need, so open your formula with an equals, open your bracket, we need to take this out of the total cash flow that we get for the next year. So we only needed 1 million. We actually got in 25 million for year 7. We only need 1. So we're just doing an apportionment. Now you'll notice it becomes negative. That's simply because this figure here is negative and it doesn't mean anything. So to take the negative away, let's put a little negative sign here and that will negate the negative for us. Now that's still expressing it in years. I could just fill this formula down and then multiply it out by 365.12 and leave it as decimal for years. But if I do that at the moment, it will refer to, as I scroll down, it will refer to the cells below these two cells. To negate that, I need to make them into what we call absolute references, and I do that by pressing F4. So let me just get my keyboard. So F4, you'll see dollar signs appear. If you press F4, this now will lock those two cells in. So if I copy this formula down, it will lock it to those two cells instead of moving them down as Excel normally would. Okay, so in the days, I multiply it by 365 days. In the months, I multiply it by 12 months and leave it as a decimal for years. So essentially, when I'm explaining my payback period in my Word document, I will say this investment, so option 1 investment, gets paid back in 6 years and say 15 days, or 6.5 months, 0.48, so 6.5 months, or 6.04 years, depending on how you are evaluating or appraising your investment. So that's the first option. For option 2, my second option, I'm just going to copy and paste all of this straight down. Now what, I can just do this. Copy and paste. Okay, and then just change my figures. So now my option 2 is office work. So again, my figures are going to come from my example that I've created in my Word document. In my case, my PowerPoint slide for you guys. So starting with my original cost and then going right down to all the future expected cash flows and including, so taking off that residual value at the end. Okay, so this one becomes negative 135. And then I have negative 5, negative 1, 10, 15, 15, 3 lots of 20, and I have 25 and then 15. Now at the end, I've got 15, and I also then have to pay for demolition of 1.5. So make sure I put that residual value in. Now, you know what, this is already calculated, so I'm just going to check that it's linking right, and it is. So that's good, I don't have to change that at all. IR should also be linked. Yep, and it is. And my cash flow, I just have to copy this and paste it down here, and it should also change for me and be correct. So just check that it is calculating correctly, and it is. Now, what I have to do is check my payback period, because my payback period won't be the same because it's a different scenario using different figures. So let's have a look till we find the last negative. That was the first thing. Go scroll along till you find the last negative and the first positive. There is no first positive. So in this case, the investment is never paid back within 10 years. I'm going to write that here. Investment is never paid back within 10 years. Okay, just so my marker knows. I actually couldn't even calculate it because it was never paid back. If it was, I would do exactly the same as I did up here. I would go along to the last negative and the first positive, put my years in the same column as the last negative, and then apportion what I needed in the first positive year. So in this case, I only needed 1 out of the 25. Make it absolute, scroll it down, and then multiply by your apportionment, so days, months, and years. Okay, so if I was to appraise this, obviously I've got a positive net present value in option 1 and a negative in option 2. So this is a no-go. Net present value, if it's negative, means you'll be losing value for your firm. If it's positive, means you'll be gaining value for your firm. So definitely option 1 we're going with. Internal rate of return, remember my discount rate was 8%, so this is higher than 8%. So again, it's a green light from the internal rate of return. In this one, it isn't. It's negative, well below my 8% required rate of return. And again, it gets paid back within 6 years and, well, just over 6 years. 6 years and 15 days, say, so or 6.5 months, or 6.04 years. If my acceptable payback period time was 10 years, it definitely falls within that time period. However, if my acceptable payback time period was 5 years, then this wouldn't get the green light. But still, because it's got a positive net present value, that trumps payback period, so I'd still be going with option 1. In option 2, it's not an option under any capital investment tool. It's no-go under net present value, it's no-go under internal rate of return, and it's no-go under payback period. So that's what I would do. Going back to my Word document, don't forget you've got to explain your decision, appraise it in your Word document, and then that's it. You're done. So have fun, and I'll see you at the next one.